Okay, hi everyone. This is the fifth lecture of Monetary and Financial Economics B2. Today we will continue the discussion related to the international monetary systems. Today we will cover these three contents: the interwar years, the Bretton Woods system, and the International Monetary Fund, and also analyzing policy options for reaching internal and external balance. Let's move on to the first lecture, first topic, the interwar years, 1918 to 1939. So during World War I, government suspended the gold standard and financed part of their massive military expenditures by printing money. So the price levels were high everywhere. So inflation occurred and the price levels were higher in everywhere, almost everywhere. Labor forces and productive capacity were reduced sharply due to the war. So after the World War I, the US returned to gold standard in 1919. And also Britain, France, Italy, and Japan returned to gold standard in 1922. So, but gold was expected to be in short supply. So a practical gold exchange standard was approved. The gold exchange standard is different from gold standard. Gold exchange standard is a small country can hold the currency of a large country whose foreign exchange reserves consist entirely of gold. So the large country have reserves as a gold. So large countries have a gold in terms of foreign exchange reserves. But small countries do not have gold. Instead, they have the large country's currency, such as dollar, franc, French franc, or Deutschmark, like that. So a small country can hold the currency of a large country, but a large country holds gold in terms of foreign exchange reserves. So in 1925, the UK returned to the gold standard by fixing the pound against the gold at pre-war prices. So key point is the pre-war prices. So the UK fixed the pound against the gold at the pre-war prices. But the price level in 1925 was greater than pre-war price level. So to reduce the price level, Bank of England implements strict monetary policy to return pound gold price to pre-war level. So therefore, severe recession and unemployment occur in UK. So investors concerned that will the UK be able to pay back foreign debt? So the investors concerned the repayment possibility of UK. So Great Depression occurred in 1929. So bank collapsed around the world. So then increased the destruct of the value of the pound increased. And also conversion of pounds to gold also increased. So many people rushed to get gold instead of pounds. Then British gold was running out. In 1933, the British gold standard was suspended due to the short of gold. So let's check the Great Depression. So Great Depression occurred in October 24 in 1929. So this is called Dark Thursday. So at the Thursday, October 24, New York stock market crashed. A series of banks and corporate and corporate bankruptcies and a series of bank and corporate corporations failed, and also unemployment spread throughout the world. So the background of this Great Depression is based on the US economic boom that is also called bubble in the 1920s. 1920s. So this economic boom in US caused higher official interest rates to suppress the boom, and also the capital outflow from the US due to the higher interest rate in the UK. So the US to suppress the economic boom in US, the government in the central bank in US, FRB, offered higher official interest rates, and also capital outflows from the US due to the higher interest rate in the UK. So each country's reaction against the Great Depression was discourage imports and keep aggregate demand locked in the home. So for example, US smooth holiday tariff is the one of the example of discouraging imports. So US smooth food tariff attempts to protect domestic industry with high tariffs. But foreign countries also reacted to imports of US products in retailization. So foreign countries also restricted US imports products. Then this gonna be the trade war. So world trade rapidly collapsed, spreading the effects of the Great Depression due to this trade war. So such policies like US smooth holiday tariffs, like to increase domestic welfare by sacrificing the economic situation of foreign countries are called bigger neighbor policy. So in Japanese, 近隣急防化政策. So this type of policy is aimed to increase domestic welfare by reducing the economic benefit of foreign countries. So, for example, US-European trade barriers hurt Latin American exports. So such kind of bigger neighbor policy hurts not only the trade partners, but also the other other countries like Latin American countries. So for example, US-European trade barriers hurt Latin America exports, and Latin America refused to pay private international debt due to the decrease to exports. Okay, many countries stopped the system of gold standard, like the UK. So many such countries began floating their currencies at foreign exchange markets, like floating exchange rate system. However, policy uncertainty intensified exchange rate volatility. So therefore, at first, many countries prohibited private financial transactions to reduce volatility. Then why did the Great Depression spread out not only to the US, but also, not only to the US and its trading partners, but almost universally? So this is because of the gold standard. In 1929, most of countries were gold standards. Then at this time, the US and France faced large financial inflows. So then these countries suffer BOP surpluses, balance of payment surpluses. So then they absorbing they were absorbing the world's monetary gold. In fact, the US and France alone held more than 70% of the world's gold in 1972. So therefore, the gold was in the US and France. The US and France had very much gold. But other countries faces the lack of gold. So try to get gold. So other countries sell their assets and raise the interest rate due to the lack of gold. So this is the rule of the game in gold standard. Then, due to the high interest rates, financial contraction occur. Then, New York stock market crash is also occurred. Then, Great Depression. So the further effect of a Great Depression occur. So the Great Depression spreads out because of the effect of Great Depression spreads out because of the higher interest rate due to the lack of gold and also New York stock market crash. Okay, so next we will cover the Bretton Woods system and the International Monetary Fund in the next video.